This is our first PowerPoint on balance of payments. The balance of payments is a country's account with the rest of the world, and it's recording all the transactions between citizens and organizations of a country and foreign organizations. They're recorded as the balance of payments. We've done in class a potato head activity where we have simulated or pretended that we are Chinese manufacturers of outrageously wonderful potato heads that are in hot demand by the United States. We may have some trade that go back and forth between China and the States, but at the end of the day, China has exported more goods to the US than the US has bought from China. This leaves China with extra US dollars, and the question is posed, what could they do with the extra US dollars? So we're going to assume that they don't want any more American imports, and they have a surplus of US dollars. Now, they're not allowed to put it under their mattress. They have to do something with it. So China could buy US exports, but we're going to assume that some trade did happen back and forth between the countries. But China, at the end, still sold more to the US than in reverse, and so therefore they had extra US dollars. Other options to spend US dollars could include, and in essence there are four things, and basically what we're talking about is buying up US assets in one form or another. So here we go. They could include buying US stocks or bonds, investing in the US and setting up firms there, which is also known as foreign direct investment or FDI. They could put money in US bank accounts, and all of the above require US dollars to do so. Or they could increase their own foreign currency reserves. So we're going to assume they cannot spend US dollars in China since the yuan is used in China and not the dollar. So what does all of this mean? So the US dollars needed to be allocated somewhere, and as I said, not allowed to be put under a mattress. And the activity of manufacturing and trading potato heads illustrates a trading surplus for China, where exports exceed imports, and we call this, a surplus on the current account. The money, in turn, could be spent investing in the US, FDI, foreign direct investment, or portfolio investment, stocks and bonds, putting money in US bank accounts, or increasing their foreign reserves of money. All of these four other options are known as the capital and financial account. So the balance of payments, the money that was received on the current account, so this was for exports exceeding imports, so the surplus US money, that money then gets used buying up US assets. So the current account has to equal the capital and the financial account, and then we add in a net error and omissions since we can't account for all the money transactions. So remember, all money must be used somehow. So the money, once again, that they were left with after trade, so the current account, all of that money was then spent on US assets or holding on to the US currency and putting it in their foreign currency reserves. So the balance payments on the current account surplus, so the exports exceed imports. There's surplus foreign currency to use up. So then on the other side, the capital and financial account, where we're going to use up this surplus currency, we could be using it to invest in foreign direct investment abroad, portfolio investment abroad, stocks and bonds. We could put money in foreign bank accounts, or you can keep it within your own country, so in this case China, but it's taken out of circulation and put into the foreign currency reserves. The current account deficit, so imports exceed exports, if we have that scenario, then foreign countries have your currency to use up. So your currency could be used to invest in FDI in your own country, portfolio investments in your country of stocks and bonds. They could put money in your bank accounts, or they could increase the foreign currency reserves in their own country. So the current account, This account is split into two major components, but I want you to realize it's also more than these two. These are the two major ones. So the merchant trade account, which records the trade in goods, and then the trade in services. But if you say on an IB exam that the current account is simply trade in goods and services, you won't receive full marks because it's also made up of some smaller entries, which you'll see in a minute. So follow the money. In order to determine if an item is positive or negative on the balance of payment account, determine whether the money is flowing out of the country, being negative, or flowing in, being positive. And another way of thinking of this is injections and leakages. Now, introducing the term credit and debit. A credit item on the balance of payments is any financial flow that leads to money entering the country. A debit item on the balance of payment is any financial flow that leads to money leaving the country. Now, one way that I remember how to distinguish between credit and debits is imagine that you've gone out for dinner. If you have a credit card and you've put the dinner on the credit card, it is if money has magically flowed into your account for you to pay for. On the other hand, if you've gone out for dinner or a movie and you pay with your debit card, then money has automatically left your bank account and money has flowed out. So the current account trade in goods. The goods could be manufactured goods, oil, raw materials for production, food items, etc. Anything that's tangible that you can touch. Service items, these are things that you can't touch, that are intangible. And note that only about 20% of all services are potentially tradable. Some examples could be financial services such as banking and insurance, tourism, transportation services, particularly shipping, law, accountancy, management consultancy, etc., etc. A service example. If you go on holiday to the States, all payments count as imports because money flows out of Canada. So payment for the flight, money spent on food, hotels, etc. So balance of international payments with Canada and the world. So we're going to look at the most current figures being in 2014, since the year 2015 is not yet over. So in 2014, were imports greater or less than exports? And in class, I've provided everyone with balance of payments data from Statistics Canada, and we have information on the current account and the capital and financial account. So in 2014, we had the situation where imports exceeded exports. And when did this change? Well, I don't have the data going far enough back from the table I've given you, but it changed in 2008. And who is Canada's largest trading partner? Well, the closest to us, and they share the same language, it's the US. So if we think, why did we used to consistently, for many, many years, if not decades, we exported more than imported until 2008? Well, in 2008, we had, of course, a financial crisis. Many U.S. firms were deeply troubled, went out of business. We had government bailouts. Terrible things were happening to the economy. So it made sense that our biggest trading partners started to buy less from us, and we moved from having a surplus on the current account to a deficit, where imports exceeded exports. Here is some historical data for Canada's current account. So we see from the 1950s to sort of around mid-1970s that imports and exports were pretty much in balance. Then for quite a period of time, we were mostly with a deficit where our imports exceeded exports, except for a few years. But then we see that for a period of time that we were consistently running a surplus on the current account where our exports exceeded imports. And then I assume at this point we're looking at 2008, where we have gone into quite a pronounced deficit, and we haven't yet recovered from that. And once again, I attribute that to our main trading partner being the States and the financial difficulty and the Great Recession that happened starting in 2008. So the current account, as I said, the two main components are the trade in goods and services, but we also have other investment income which we have to take into account. So if we think of the term current is things that flow, literally like a river. And so we're looking at income as opposed to assets that are owned. So how does money flow? Well, we look at things like income earned on investments, things like interest, profit, dividends that are given from sharing the profits amongst shareholders. So interest is earned on bank deposits and government bonds. Profit is earned from investments in a business enterprise, and dividends are earned annually on shares. There's another current account item, which are transfers. These are government transfers and transfers made by other sectors. They're called transfers because they do not reflect any actual trade. So in other words, money is given without any expectation of receiving goods or services in return. So government transfers could include contributions to the Common Agricultural Policy and foreign aid. Other transfers could include wages sent home by foreigners working in the United States, or the transferring of assets by individuals to foreign bank accounts. So the current account balance, so if you were given this on an IB exam and you were asked to describe what is the current account, you would say that it's trade in goods and services. You would also say that it's investment income flows, and a very small component, but anyway, is also government grants and private transfers. So Canada's current account. What is the largest item on the current account? Well, again, from the Stats Canada tables that I've handed out, we see that it's the trade in goods and services. And if we look at the second largest item, well, it's going to be the services alone. So in 2014, what was the total current account balance? Well, it was negative $41,479 million. This means that we were in deficit, and in a deficit, basically what's happening is that imports are exceeding exports. Yes, we have those other small accounts on the current account, but as I said before, imports minus exports are the lion's share of the current accounts. So looking on the flip side, the capital and financial accounts. If we have a surplus on the current account, it's offset by a deficit in the capital and financial accounts. Or if we have the opposite, if we have a deficit on the current account, it's offset by the surplus of the capital and financial accounts. The capital account is a relatively small element of the balance of payments. It includes capital transfers, such as debt forgiveness and migrants transfers. It also includes acquisition and disposal of non-produced, non-financial assets, such as land purchases and sales associated with embassies and other extraterritorial bodies. So if we look at the Canadian situation, I don't have this data. Okay, so if you have the tables, you could look up the capital account, the net flow for Canada in 2014. Actually, I do have that. It is $115 million, so relatively a small account. And how does this compare to the financial account? It's much smaller. The financial account. The financial account records transactions associated with changes of ownership of a country's foreign assets and liabilities. The financial account is divided into 4 main sub-accounts. Now, we've looked at these before, but you really need to be able to list these four. So we looked at direct investment, or FDI. We've looked at portfolio investment, being stocks and bonds. We've looked at other investments, such as putting money into foreign bank accounts. And reserve assets is where we're putting money into our foreign currency reserves. Each showing inflows of money, being credits, and outflows of money from a country, being debits. And again, think of a debit card and a credit card. In which case is money flowing in which case is money flowing out. The financial account, direct investment. So we'll look at these four different kinds of financial account entries, starting off with direct investments. So it refers to the money that flows across national boundaries for the purpose of investing in a business enterprise. Essentially, it records the transfer of business ownership. So it's involved with actually the ownership of a firm, and then that can also involve directly managing and working with the firm as well. It also records money invested abroad for a new business venture. Okay, so the first one could be where you're buying an existing business. The second one is where you are setting up a brand new business. Now note, the earnings, however, from these investments, the profit, they then appear in the investment income of the current account. So the top part of this is referring to an asset, an ownership of a firm. This is an income, the earnings, because it's what flows from the asset's activities. So it becomes part of the current account. The top part here is part of the financial account. The earnings is part of the current account. Portfolio investment, another one of the four entities of the financial account. This is money that flows across national boundaries for the purpose of investing in shares and bonds. So if someone from the US bought shares in a UK company, then this would be recorded as an outflow of money from the US. So this is an asset, part of the financial account. But then what you earn from owning these shares, meaning the earnings, the dividends and the interest, they're part of the investment income on the current account. So up here is an asset and ownership, part of the the financial account. The dividends and interests are part of the current account. Other investment. This can be the short-term banking flows, putting money in foreign bank accounts, but it also could include net government borrowing from foreigners. And official reserves. Official reserves can be gold and foreign currencies that governments hold for use by the government. So look at the change in reserves if a country is buying or selling currency, just as an example. So what happens when it goes into the official reserves is, even though it's within that given country, it is considered as if you were buying up assets of another country, because you're taking that other country's currency, putting it into your reserves, out of circulation of the economy, and holding on to it again like an asset. So it's part of the financial account. So net error and emissions. It's a difference figure between the items in and out which were not recorded. It's very difficult to collect all the data required to record the balance of payments accurately. And also we might have a time lag as well in recording transactions. So the capital surplus has to balance the current deficit. Sorry, and I should say not just capital, but the financial and capital surplus has to balance the current deficit. The demand for every dollar has to be matched by an equal supply. So this next equation is very, very key in all of the balance of payments material. The net balance of payments equals the current account plus the capital account plus the financial account plus net error and emissions, and it must equal 0. Now the reason it equals 0 is, let's say if we have a surplus on the current account so that would be money in, we know we would have a deficit on the financial and capital account, which would be money out. One would be positive, one would be negative, balancing out to zero, or vice versa if we had a deficit and a surplus. So the Canadian balance of payments. What was the balance of the total current account in 2014? Well, again, according to our data from Stats Canada, we have negative $41,480 million. If we look at the total capital and financial net flow, we would have balance of the total capital and financial account, we would have 37,178 plus the 115 million. And what is the statistical discrepancy error in 2014? And if we add up all of these accounts, it's a wonderful thing to see. If we have and it does indeed equal zero. So just proving out the theory.